Good morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, today we're talking about the two Canadian banking giants listed on the Trinidad and Tobago Stock Exchange, and of course we're talking about FirstCaribbean International Bank, or FCI, and ScotiaBank Trinidad and Tobago, SBTT. Now, both companies would have had differing results on account of certain one-off items. Let's take a look quickly, and turning first to FirstCaribbean, or FCI. The group or the bank reported earnings per share of just around 30 cents TT equivalent, which was a decline of around 11.8 or roughly 12% from that 34.2 cents recorded in the prior 6-month comparable period. Now, the good news is that net interest income was up just around 3.9% from 1.35 to just around 1.4 TT equivalent billion dollars, and total revenues were up around 5% from 1.9 to just over $2 billion TT equivalent. Now, income before taxes were up a very healthy 19.4% from around 600 million to 714 million TT equivalent, but some one-off items, including additional impairments related to the Barbados government debt restructuring, as well as some tax deferral, the write-off of some deferred tax assets would have sunk into FCI's or taken a bite out of FCI's earnings and led to that overall decrease in net income for the period of around 10.3%. Now, looking at the revenue story, the revenues of FCI continue to trend upward very nicely. As we said, total revenues overall were up just around 5.7%, and net interest income was up just around 4% as well, from that 1.35 to $1.4 billion. Now, operating income, which includes fees and commissions, were also up just around 10%, from about 570 to 635 million. But net interest income really accounts for around 70% of FCI's total interest income. Nonetheless, nice upward trend over the past 5 comparable periods. And in terms of profit before taxes, we can see that the corporate and investment banking segment in green continues to account for just around 2/3 roughly of overall profit before taxes. Nonetheless, wealth management had a very nice, almost 24% increase from 86.8 to 98.9 million TT equivalent, and that's in the blue segment there. And retail and business banking, which benefited from some one-off items, increased from 89.5 to 219 odd million. Now, at a price of around $8.31, FCI is trading at a price-to-earnings ratio of just around 22.5 times, which is above the sector average of 16.3 times. But when we adjust for a lot of the one-off items that would have taken place in the past year, that PE ratio falls to 11.7 times. So on that basis, a little bit more value. And the company or the stock offers a very attractive trailing dividend yield of around 5.3%, which is above the sector average of just around 4%. Now, take that with a pinch of salt. That includes some special dividends, which were recently declared. Excluding those special dividends, that dividend yield falls from that 5.3% to 4%. So certainly we can't see that the special dividends will persist in the future, but as of now, shareholders are enjoying that elevated dividend yield. So on the basis of fairly attractive dividend yield, or quite attractive current dividend yield, some fair to find valuations, but again, tempered by that, the continuing fallout from the Barbados debt restructuring, Bourse maintains a neutral rating on FCI. Turning quickly to ScotiaBank, and for the period ended, or the 6-month period ended 30th April 2019, the bank reported adjusted profits, earnings per share of just around $1.94, which was an 11% increase from the 175 recorded in the prior comparable period. Again, similar story. Net interest income and total revenues were up, but by a smaller margin. Total revenues were up just around 2.3% from 899 to just around $920 million. And income before taxes, in this case, was up just around 0.5% from 464 to 466 or $467 million. Now, in the case of Scotia, there was a one-off tax item which actually benefited the company, and that was a tax credit which lowered its tax expense just some $36 million, or a 22% decline from 160 to 124 million, and that led to profit for the period increasing that 12.8% and overall earnings increasing just around 11%. When we take a look at the revenue story for Scotia, again, a nice upward trend over the past 5 comparable periods, but it has been slowing down to some degree. So after a 7.9% increase, 12.1% and 11.1% in 3 of the past 5 periods, we can see that growth in revenues has come down quite significantly to 2.8% from 2017 to 2018, and now 2.3% in revenue growth from 2018 to 2019. So slowing down in terms of revenue growth, but nonetheless, very healthy in terms of rewards to shareholders. And what do we mean by that? At its current price of around $62.50, ScotiaBank is trading at around 16.5 times price to earnings, which is, again, in line with the sector average, and offers a regular dividend yield of just around 4.8%, which is above the sector average of 4%. So based on its its fair valuations rather relative to the market, but its attractive dividend yield and slowing revenue growth, Bourse maintains a neutral on ScotiaBank. That's it for this week's edition. Now, if you own Sagicor shares and would like to find out a bit more about what the prospects are for the company, particularly as it relates to the proposed, and now voted approved takeover between Sagicor and Alinvest, you can register for a free Sagicor webinar, which takes place next week, Tuesday. You can call 226-8773 for more information. Email us at invest@boursefinancial.com or visit our website at bourseinvestment.com. Have yourselves a wonderful investing week. This has been the Bourse Report.